Ever wondered how to evaluate a company's stock? It's a bit like solving a puzzle, fitting together various pieces of financial data to reveal the bigger picture. One essential piece of this puzzle is the price per earnings ratio, or the PE ratio for short. This is a key metric that investors often use to make informed decisions about buying, selling, or holding onto a company's stock. So buckle up, financial explorers, and stay tuned as we delve into the intriguing world of the PE ratio. So, what exactly is this PE ratio, you might be asking? Well, the price per earnings ratio, or PE ratio, is a simple yet powerful tool used in the world of finance. It's essentially the ratio of a company's share price to its earnings per share. Imagine you're at a market and you're trying to decide which fruit to buy. The PE ratio is like the price tag on each fruit. It tells you how much you are paying for each dollar of a company's earnings. Now, let's break it down a bit. Say, a company's share price is $50 and its earnings per share is $5. The PE ratio would be 10. This means, as an investor, you're paying $10 for every dollar of the company's earnings. The lower the number, the less you're shelling out for each dollar of company earnings. The PE ratio, in essence, is a measure of how much investors are willing to pay per dollar of earnings. Now that we understand what the PE ratio is, why is it significant? Well, the price-to-earnings ratio, often simply termed as the PE ratio, is like a magnifying glass for investors. It helps to zoom in on the value of a company's stock, offering a comparative tool. Imagine walking into an apple orchard. You see two trees, one with 100 apples, the other with 50. But here's the catch. Both trees are priced the same. That's where the PE ratio comes into play, helping you determine which tree, or in our case, which stock, gives you more fruit for your buck. Moreover, the PE ratio can signal if a stock is overvalued or undervalued. It aids investors in making informed decisions about when to buy and when to sell. The PE ratio is a crucial tool in the arsenal of any savvy investor. However, like all tools, the PE ratio has its limitations. Now, let's delve into the drawbacks of relying solely on the price per earnings ratio. One significant limitation is that the PE ratio doesn't account for differences in growth rates among companies. A high PE ratio might be justified for a fast-growing company, but could signal overvaluation for a company with slower growth. The PE ratio can also be skewed by non-recurring items. For instance, if a company sells a major asset and records a one-time profit, its earnings for that period will be artificially inflated. This can lead to a misleadingly low PE ratio. Changes in accounting rules can also distort the PE ratio. If a company changes the way it calculates its earnings, it can significantly alter its PE ratio, making it difficult to compare with other companies or with its own historical ratios. Furthermore, the PE ratio doesn't consider the quality of earnings. It doesn't distinguish between earnings from ongoing operations and those from one-off events. Nor does it account for the sustainability of a company's business model. A company with a low PE ratio but a shaky business model might not be a good investment. While the PE ratio is an important tool in stock evaluation, it should never be used in isolation. Always consider other factors and metrics in your investment decisions.